Hi, welcome to Finivize. About a month ago, Silicon Valley Bank was ranked among the top 20 in Forbes' list of best US banks of 2023. And just a few weeks later, the same bank came crumbling down and even shut down. What a paradox! Regulators shut down the once trusted bank of venture capital investors and internet entrepreneurs last Friday afternoon, making the second largest bank failure in American history. Despite the ongoing economic upheaval in recent months, many never expected this sudden full-fledged implosion of Silicon Valley Bank. Even if we could have suspected that the iconic financial institution was going down the drain, no one anticipated that it would shut down so quickly, almost immediately after announcing its difficulties. This event will undoubtedly have a significant, widespread, and potentially catastrophic impact on people. It could be the beginning of another Great Depression. Sit back and ride with us as we discuss how the second biggest bank collapse in US history happened in just 48 hours. Silicon Valley Bank is the biggest US bank collapse since Washington Mutual during the 2008 financial crisis. The company's downward spiral began on Wednesday when it shocked investors by announcing that it needed $2.25 billion to level up its balance sheet. The effect was the rapid downfall of a once respected bank. Within 48 hours, the venture capital community that SVB had served and nurtured induced a widespread panic that brought the bank's 40-year history to an end. The fall, how it began. Everything was going well until the Federal Reserve Bank started raising interest rates aggressively. About a year and a half ago, due to the massive influx of capital deposits, the bank invested a whopping sum of $91 billion in bond securities. The bank's huge loss is strongly tied to the recent rise in interest rates, given the company's US Treasury holdings were purchased when interest rates were still relatively low. Note that bond prices decline as interest rates increase. Okay, let me explain this briefly so you understand the correlation. When interest rates rise, companies and individuals cut back on their spending. They borrow less but tend to save more. Since there's little money in circulation, this causes earnings to fall and stock prices to drop. On the other hand, when interest rates fall back significantly, consumers and businesses tend to increase spending because they can easily borrow more funds from financial institutions and pay a low interest rate, thus leading to more money in circulation and finally causing stock prices to rise. The Fed typically raises interest rates to cool down an overheating economy or curtail inflation. You might wonder how it affects bonds. Bonds are susceptible to fluctuations in interest rates. When the Fed raises interest rates, the market price of existing bonds falls instantly. That's because new bonds will soon come into the market and offer investors higher interest rate payments. Hence, existing bonds decline in price to make their lower interest rate payments more appealing to investors for purchase. The drama began when SVB was confronted with the new reality of increased interest rates. Firstly, SVB faced interest rate risk on its huge funds and bonds. The company's $21 billion bond portfolio has a yield of 1.79% and a term of 3.6 years, according to SVB Financial's revised investor deck. The 3-year US Treasury note currently yields 4.7%, a long cry from the rate at which the bank purchased Treasury notes prior to 2022. Besides, Silicon Valley Bank isn't the only one affected by collapse by higher rates. As startup clients withdrew deposits to keep their businesses afloat in the ongoing economic crisis, SVB found itself short on funds as well. The bank had been forced to sell all its available for-sale bonds at a loss. This caused the value of SVB's bonds investments to plunge, as there were many other alternatives for investors to buy short-term bonds or money markets at 3% or plus 5% yields. According to the Financial Times, the company completed a fire sale of $21 billion bond portfolio and ended up with huge losses of around $1.8 billion. The bank later announced plans to raise an additional $2.3 billion from investors by selling stock, basically expanding stakeholders to cover bond sale losses. Also, another factor that crumbled SVB Financial state is the fact that it mainly tends to venture capital and private tech companies, which often rely on the IPO market to cash in their equity stakes and raise money that is often held at the bank, help boost deposits. However, with the IPO market officially closed for the past year, SVB Financial has suffered a steady reduction in deposits. Credit rating agency Moody cut SVB's credit rating to Baa1, and downgraded the bank's credit outlook to negative because of the potential negative implications for SVB if the declining venture capital investment activity and high cash burn does not subside. The decline in SVB Financial dragged down the entire banking sector on Thursday, sending shockwaves through the industry as investors wondered if problems at the bank could be prevalent at other growth-oriented banks. The death blow. After the announcement, by the end of the next day, customers had withdrawn a staggering amount of about $42 billion of deposits, according to a California regulatory filing. And by the close of business that day, SVB recorded a negative cash balance of $958 million. Falvey, a former SVB employee who founded his own fund in 2018, likewise blamed the bank's failure on the extremely interconnected structure of the tech investing sector, stating that his analysis of SVB's mid-quarter update as of Wednesday gave him confidence. The bank was well capitalized and could manage the crisis, he said. He even counseled his portfolio companies to keep their funds at SVB even amidst the chaos and rumors. Nothing could be more devastating than seeing prominent firms, such as Union Square Ventures and Coatue Management, send out emails to their entire rosters of startups instructing them to pull out their funds from SVB on concerns of a bank run. Social media only heightened the panic, he lamented. It's like screaming fire in a crowded theater when you say, "Hey, get your deposits out, this thing is going to collapse," Falvey explained. It's become a self-fulfilling prophecy. SVB was certainly unprepared for this. This will go down in history as an example of an industry ripping its nose off to spite its face, lamented Ryan Falvey, a fintech investor at Restive Ventures, because as of Thursday evening, some SVB customers received emails reassuring them of business as usual at the bank. That is to say, everything was under control. CNBC got a copy of the mail, and it read this: "I'm sure you've been hearing some buzz about SVB in the markets today, so wanted to reach out to provide some context. It is business as usual at SVB. Understandably, there may be questions, and I want to make myself available if you have any concerns," the banker wrote. SVB Financial CEO Greg Becker also reassured investors in a shareholder letter that SVB is well capitalized, with a high-quality liquid balance sheet and peer-leading capital ratios. But on Friday, the value of SVB stock had plunged dramatically, and efforts to sell shares had also failed. The abrupt withdrawal of deposits has rendered the bank unable to meet its commitments as they become due. The bank is now bankrupt. Now, thanks to the bank run that ended in SVB's seizure, what becomes of those who remained with SVB face an uncertain timeline for retrieving their money. Business owners are already concerned about meeting payroll, which might lead to unexpected closures and layoffs. "It's horrible," said one venture capitalist. "Our hearts go out to everyone who has been impacted." However, Silicon Valley Bank has been closed by regulators, which are now in charge of the bank's deposits. According to Bloomberg, the U.S. Federal Deposit Insurance Corp, FDIC, which intervened and shut down SVB on Friday due to an extraordinary rush on money by its clients, is seeking to complete the auction before markets open this week. So, an auction for the collapsed Silicon Valley Bank's remaining assets is underway. A quick sale could enable the FDIC to make at least some of SVB clients' uninsured deposits available to them by Monday. Already, the U.S. agency has stated that the insured sums will be made accessible in full by the start of next week. The bank is set to reopen this week. The ripple effects. The run on Silicon Valley Bank had only succeeded injecting more panic into an already slumping stock market. Adding to the existing chaos is the recent announcement of Silvergate Capital. The crypto-oriented bank announced it would cease operations. The urgent need for additional capital, following the failure of crypto-focused Silvergate Bank, triggered another round of deposit withdrawals that same Thursday. Since then, Silvergate stock has dropped by more than 40%, while Signature Bank, which has some ties to the crypto industry, has dropped by more than 11%. With a severe downturn in the banking sector, investors are becoming increasingly risk-averse as concerns about potential sector contagion grow. Bank stocks came crashing down ever since, as the collapses of Silicon Valley Bank and Silvergate Capital sent shockwaves through the industry. JP Morgan Chase, Bank of America, and Wells Fargo all dropped more than 5%, while the regional banking sector plunged as much as 8%. The decline accelerated throughout the day, with SVB Financial shares falling as much as 62%. The KBW Bank Index fell 7.7%, its greatest decline since June 2020. The unexpected news at SVB Financial, which highlighted the fact that a prolonged downturn in private markets and venture capital had reduced its deposit levels, pushed down other California-based banks such as PacWest Bancorp and First Republic. PacWest Bancorp saw its shares fall by more than 20%, while First Republic, another growth-oriented bank, saw its stock fall by more than 15%. The big question right now is if banks are failing, where can people keep their money safe? It's apparent that explaining the bank's current state or failure will not stop the ongoing panic. The story is fast-paced and ever-changing. However, any deeper, long-standing causes for SVB's collapse will no doubt unfold in the coming days. But the coup de grace was a traditional bank run. This is just the beginning of the impact of Silicon Valley Bank's implosion. Enjoy the video? Now watch this one.